Today, we're essentially cracking open the vault on the ultimate rules of the game, the exact strategies the ultra-wealthy use to legally bypass the IRS. If you've ever found yourself wondering how the top 1% can manage to amass these absolutely massive real estate portfolios while paying just a fraction of what you'd expect in taxes, well, you are definitely in the right place. We're keeping it strictly to the numbers, the laws, and the strategies drawn directly from the tax code itself.
There's a quote that perfectly captures exactly what we're talking about today. Billionaires don't just buy real estate for the rent. They buy it because it's the ultimate get-out-of-taxes-free card. And man, is that true. Today, we're going to examine the actual structural mechanics of the tax code that turn real estate into a massive legal shield. We're talking about specific, incredibly powerful provisions that allow investors to aggressively shrink their taxable income, completely defer capital gains forever, and ultimately transfer their wealth totally tax-free. Let's break down exactly how this playbook actually works.
All right, Chapter 1, the Phantom Expense Illusion. We are starting off with what honestly feels like a legal magic trick. It's the absolute bedrock of real estate wealth. And here's the crazy part, the IRS actually encourages it. Yet so few everyday taxpayers fully understand how it works. It all revolves around something called depreciation. So the crucial concept to grasp here is that while your building's value is likely climbing up in the real world, the IRS actually lets you pretend it's losing value on paper. The tax code recognizes that buildings experience physical wear and tear over time. They usually calculate this over 27.5 years for a residential property. So they let you take a deduction for that supposed reduction in value. It creates a phantom expense because, well, it doesn't cost you a single dime out of your actual bank account.
Let's put this into perspective to show you the true power of this phantom expense. Imagine you invest in a rental property, and it generates a very real, very tangible $5,000 of positive cash flow that goes straight into your pocket. Awesome, right? But at the exact same time, the IRS tables say your property suffered $10,000 in depreciation. You subtract that $10,000 phantom expense from your $5,000 actual cash income, and suddenly you have a $5,000 paper loss. You literally put cash in the bank, but you get to legally tell the government you lost money. It entirely wipes out the tax bill on that rental income.
But wait, it gets wilder. Sophisticated investors put this depreciation concept on steroids, using something called cost segregation. Instead of waiting decades for that phantom expense to slowly trickle in, they hire specialized engineers to literally carve out specific components of the building, things like HVAC systems, specialized lighting, even landscaping. Because those specific items have much shorter lifespans, the IRS allows you to accelerate their depreciation. By doing this, investors can legally write off up to 25% of the total property value in year one alone. That is a massive, immediate injection of tax savings.
To really grasp the sheer scale of these mechanics, let's look at a neutral historical example. If we look at Donald Trump's reported 1995 tax records, documents that leaked to the press a while back, they showed a staggering $916 million loss to offset his income. Now, totally setting politics aside, this just serves as a perfect textbook example of the mathematical scale of the real estate playbook. When you utilize massive depreciation deductions on giant commercial properties, high-net-worth developers can generate paper losses so gigantic that they can offset decades of actual, real-world taxable income.
And here's where the tax code gives real estate a totally unique pass. In almost any other business, you can only claim losses on the money you personally put at risk. Makes sense, right? But real estate professionals enjoy a massive exception. They can buy huge property using almost entirely borrowed money from a bank, often using non-recourse loans where their personal assets aren't even on the hook. Yet, if that property generates a massive paper loss through depreciation, the investor gets to claim the full tax benefit of that loss, even though the money at risk actually belongs to the bank. It's wild.
Moving on to Chapter 2, the real estate professional status. Now, you might be thinking, okay, that's great for billionaires, but what about high-income earners? What if you have a massive salary from a regular job? Can you use these phantom real estate losses to protect your W-2 income?
Well, let's look at a fascinating case study of someone we'll call Jean. She's a highly paid medical doctor. By default, the IRS says real estate is a passive activity, which means normally you can only use passive real estate losses to offset passive real estate income. But Jean used a very specific legal loophole, the real estate professional status. By shifting her working hours, she unlocked the ability to use her massive real estate paper losses to completely wipe out the active income she earned as a doctor in her clinical practice. Ultimately, she paid less tax while actually making way more money.
But the IRS doesn't just hand this superpower out to anyone. You've got to clear two very strict, highly documented hurdles.
First, more than 50% of your total working time must be dedicated to real estate. Second, you have to spend a minimum of 750 hours a year materially participating in your real estate business. If you can pass this test and you keep the rigorous logs to prove it, that wall between your passive real estate losses and your active working income completely dissolves.
Okay, Chapter 3, the infinite deferral loop. So, you've taken all this depreciation, you've shielded your income, awesome. But what happens when you finally want to sell that highly appreciated property? Normally, you'd be staring down the barrel of a massive capital gains tax bill, plus a painful tax on all that recaptured depreciation. Enter Section 1031 of the tax code, the infamous 1031 exchange. Institutional investors utilize this to essentially swap one investment property for a bigger one, and by doing so, they completely defer the capital gains tax. You sell a building, you make a massive profit, and you roll 100% of that profit straight into a new building. You pay absolutely zero tax today. And the crazy part? You can do this infinitely. You can trade up from a duplex to an apartment complex, all the way to a skyscraper, just letting your wealth compound tax-deferred for decades.
But listen, the timeline for this loop is incredibly strict. You literally cannot miss these IRS deadlines by a single day, or the whole magic trick just blows up. Here's how it works. You sell your property, but you cannot touch the cash yourself. It has to go to a middleman called a qualified intermediary. From the exact day you sell, the clock starts ticking. You have exactly 45 days to formally identify a replacement property and exactly 180 days to fully close the deal. You stick to those rules, and that tax bill is pushed infinitely into the future.
Which brings us to Chapter 4, Buy, Borrow, Die. Yep, you heard that right. If you keep infinitely deferring your taxes by swapping properties forever, you might be asking, when do you ever actually pay the tax man?
Well, this timeline right here is the ultimate endgame of the playbook. This is how the ultra-wealthy extract millions in spending power without ever selling their assets. First, you buy and appreciate the real estate. Second, you borrow. Instead of selling the property and paying tax on the gain, you take out a loan against the newly created equity. Because borrowed money is debt, it is never classified as taxable income by the IRS. So you get millions in cash to fund your lifestyle, totally tax-free. And then, step 3, you simply hold those assets until you pass away.
And then comes the die part. The absolute grand finale relies on a rule called the step-up in basis. When you pass away, your heirs inherit the property, right? But the IRS resets the property's cost value to whatever it is worth on the exact day you die. All of that tax debt you strategically deferred over your entire life, it's completely wiped clean, gone. Your heirs inherit a massive portfolio, and they could literally sell it the very next day and pay absolutely zero capital gains tax.
All right, final section, Chapter 5, Build Your Financial Fortress. We've talked about the billionaires and the ultra-wealthy, but how does an everyday taxpayer actually use this stuff? How can you ethically apply these exact same rules?
The truth is, you absolutely do not need a skyscraper to get started, especially if you're a young adult looking to build wealth early on. You can map these grand institutional strategies right down to very accessible moves. For example, young investors can start with house hacking. You buy a duplex, live in one side, and heavily depreciate the rented side. And instead of multi-million-dollar 1031 property swaps, you can leverage specialized trust structures to achieve those same institutional-grade tax benefits.
And if you eventually get totally sick of being a landlord, but you want to keep your wealth compounding tax-free, say hello to the 721 exchange. You start by using a standard 1031 exchange to move your money into a Delaware statutory trust, which is managed entirely by professionals. After holding it for 2 years, you convert those interests into shares of a massive real estate investment trust, or REIT. Boom. You just traded your physical property management headaches, all the tenants and toilets, into totally passive, diversified, dividend-paying shares. And you did it all without triggering a massive tax bomb. At the end of the day, the tax code isn't just a list of penalties. It is literally a map of incentives written by the government. Understanding these rules isn't about exploiting some shady system. It's about shifting your mindset. It's about looking at real estate not just as a place to live, but as a heavily incentivized vehicle to legally, efficiently build a generational financial fortress for yourself and your family. So I'll leave you with this. Knowing what you know now about how wealth is truly built and protected in this country, what is your next move going to be?